Good afternoon, everyone. And thank you all for joining me. It's been way too long since we've been able to do one of these events. In fact, the Sydney event was almost 3 years ago, June 19. So I'm so happy to see so many familiar faces and also some new faces in the audience today. But before I go any further, I'd first like to acknowledge the traditional custodians of the land on which we each gather today and pay my respects to our elders past, present and emerging. Before I go any further, there's a whole lot of words up here on the screen. You can try and read it as quick as you want. Good luck. What it really does say, and this is an important point, nothing we're about to say today should be taken as financial advice. The aim today is to educate, give you information on the funds, and we always tell people if there is something that you're potentially interested in, always read the product disclosure statement or the information memorandum in full, read the risk section, and if still in doubt, please do contact a financial advisor. So I just said it's been almost 3 years since I've been here, so I'm going to kick off today and give you an idea of what we've been doing. It's been a very busy period and investors have had a good run. So I'll set the scene for today before you hear from our guest speakers, and then I'll finish up covering off the direct funds. So as we stand at 31 December, Charter Hall is a shade under $80 billion of funds under management. The blue bar shows how it's spread across the different equity sources, and importantly, around 70% of all the money that we manage is on behalf of wholesale and institutional investors. The other colour chart shows how the asset classes are split. So we believe at Charter Hall we'll give everyone the best opportunities to invest, but it's up to each individual to decide what's right for them or if the sector's even appropriate. So the grey bar is really the newest bar, which has increased materially, which is following that Paradise investment. And in fact, a little known fact, and we probably should get the information out more, Charter Hall owns and manages on behalf of our clients more real estate in this country than anyone else. I say that not to brag, but in real estate, scale is very helpful. You get off-market opportunities, you have deep relationships across the various tenants, and it allows you to source the best quality assets for our suite of funds. And to give it a bit more perspective graphically, we own over 1,500 assets, primarily in Australia, but also New Zealand. And because we are here in the Ivy Ballroom today in Sydney, I thought it worthwhile putting up New South Wales, which is 453 of those assets. But importantly, Charter Hall, regardless of where we own the properties, has teams of experts on the ground to manage them. Because it isn't just acquiring the best assets. Driving value means that you need to manage them better than others and extract as much cash flow and valuation uplift for our clients as possible. And one of the ways that we do this is a slide that shows the top 15 tenants across the entire suite of real estate funds. It's not an accident that you see the names up there that you do. Government, Coles, Telstra, Amazon, Audi. We targeted these type of tenants because they have fantastic balance sheets, generate terrific cash flows, and I must admit, we originally targeted them to make sure that they can go through different economic cycles. What we didn't necessarily know was that they would also be terrific tenants to go through a global pandemic as well. So this is one of the things that has really set Charter Hall apart in how we've curated the tenant customers which fill our buildings. But we are long-term owners of real estate. I always tell people, you never invest in property for a short period of time. One of the trends, which we've been onto for well over a decade, but which has intensified through COVID, is the focus on ESG, so environmental, social and governance. Put simply, not only is it the right thing to do, but if you don't do this, you cannot attract those tenants that I just had up on the slide. They want to make sure that they're going into an environmentally responsible building, that the manager acts as a good corporate citizen. So the way that we protect and enhance value is to make sure that we target this kind of thing. So I could talk about that for the whole day, but instead I thought I'd just give you one small example. Up there on the screen is the amount of kilowatts on the industrial and logistics portfolio, which we're aiming to do in 2023. At 11,000 kilowatts, what does that mean? Not necessarily that helpful unless you're in the energy market, But that will power over 2,000 houses each and every year just from the solar on our new industrial logistics assets. So not the ones that we already own, not the ones we're retrofitting, not what we're doing in the retail centres, just a small part of the portfolio. And because there are many new faces in the audience, and because it has been a while since we've done this, I thought it'd be worthwhile to spend a minute refreshing on what exactly is unlisted property and why does it make sense. Well, it does have lower volatility, which can, when it's incorporated with other assets, reduce an investor's overall portfolio risk. Keep in mind that because real estate is a long-term investment, it does not have the same liquidity characteristics as listed stocks. It provides portfolio diversification. Over the medium to longer term, it can provide some inflation hedging characteristics, and it has a low correlation to other major asset classes, such as Aussie equities and international equities. So I've now just talked about how we've done business, the pandemic, what we've been up to in the last 2 years. But what's the end output? What does it look like from our investors' point of view? So I got the team to analyse the 10 funds which were around in March 2020 and which are still around today. So 2 years, heavily COVID impacted, and have averaged the highest returns, so 28% per annum total return, capital and distributions, and the lowest return in the portfolio was 12.6%. So across 10 investment property funds, this is a fantastic result. And it's largely why we've got such a happy customer base. But I never tell people to expect these kind of 28% returns. Please do keep in mind that over long periods of time, unlisted property delivers 8 to 10% returns. And so to get a little bit more granular, did we stop doing deals? Did we stop doing lease extensions? Absolutely not. In fact, during the last 2 years, the direct business acquired almost $2 billion of high-quality commercial property. But buying assets, to be honest, not that hard. You just need to pay more than the next nearest person. But we didn't do that. Across the portfolio of acquisitions, they had an average occupancy rate of 98.3%. That's higher than all PCA, or Property Council of Australia benchmarks, and the weighted average lease expiry, or WALE, was 8.5 years. So we very much stuck to the investment criteria that we said we would in the relevant offer documents. We bought 2/3 of the properties off market. That means we weren't waiting for the property to be for sale in the AFR. We utilised our relationships with tenants. We've done over $5 billion of sale and leaseback deals in the last 5 years. We've sourced properties off market because of our relationships with private equity groups, with agents, and because when we sell a property, we give the appointment to not only the best selling agent, but the agents who give us the best deals to buy. But we always had an eye on the risk. None of our funds that are open for investment exceeded 40% gearing. There was something that many of you may be aware of, but for those who are in property, I'll explain it. The government's brought in this country what's called the rental relief. Basically what it meant was small and medium tenants, as a landlord, you had to give them rent-free. Because our tenant quality was so high, the big tenants didn't need it, and we didn't have to provide it. In fact, no fund offered more than 2% of rent-free in the COVID period. But there are some important exceptions. The small tenants, typically your food and beverage or coffee shops or the base buildings of office, we helped them out. Not just because financially you wanted to have a good operator there at the end of COVID and to trade through, but because, again, it was the right thing to do. So those smaller tenants, we did the right thing by them, and it's also protected investors' value. The occupancy rate never dropped by more than 2% for any of our funds. So the team, again, pulled up the occupancy at 31 March 2020, compared it to 31 March 2022, and it barely moved. Some went up, but I'm just putting up here the ones that went down. And importantly, debt terms. We always try and extend the debt early and for as long as we can. It does cost us a little bit more in terms of the margin, which we have to pay, but in our minds, that's cheap insurance. So we always get in early, we push out the debt terms, and we remove as much of that refinancing risk as we can. So look, hopefully that gives you an idea of how Charter Hall, what we've been doing for the last couple of years, how the funds have returned overall, and the way we like to do business. And in fact, it's now an introduction to our next speaker, Carmel Hourigan. Carmel leads our $24.9 billion office sector, which includes funds management, asset management, development, and property teams. Her role includes helping to develop the overall strategy and objectives for the office funds and guiding the teams on how to execute the strategy. She's highly experienced in the sector, and Carmel believes that partnerships are underpinned by mutual purpose and not just benefits. Before joining us, Carmel held positions at AMP Capital, the GPT Group, Lendlease, as well as Challenger. Committed to raising the profile and opportunities for women in the industry, Carmel sits on the Property Council of Australia board. Please welcome to the stage, Carmel.
Well, it is so good to be here and have all of you in person. You're an office CEO's dream come true. But we'll talk about the office markets, which I'm sure you've heard a lot about in the last 2-3 years. So we have 25 minutes and I'm going to move quite quickly. We do have questions at the end of the presentation and we can sort of double back on some things. So I'll just basically today give you a quick overview of what we're seeing in terms of the economy and how it's impacting office markets. And we'll talk about some of the key, what our strategies are and how we're adjusting to what we've seen post-COVID. And then we'll talk about some of the thematics that we're seeing, because you would have heard a lot about flex working, co-working, how's this going to impact hybrid work and so on. So I'll touch on some of that as well. So I won't stay too long on this one because I think you've heard it. Obviously, we manage one of the largest, it currently is the largest office portfolio in the country. We have around 85 assets. We have a regional model. So we have people in every state, and I call that out because it is a difference and it enables us to be quite insightful about what's going on. And we also have development people in most states as well. So that gives us access to deals, on the market knowledge about tenant customers and what they're doing in those markets as well, and places us in a pretty good position. We manage around 1.8 million square metres. That's a lot of space. And we have about a $5 billion development pipeline, of which around $3 billion is under construction at the moment. And I'll touch on some of that. And we have 147 people in the office business, all working on office, out at the assets, property managers, and also our funds management and development staff as well. So, a lot of icons on here, but I'll just maybe touch on some of the key things that we've seen over the last 12 months, and then maybe some of the things that we should all be thinking about in this room over the next sort of 2 years, 3 years. So obviously we had COVID, we've had Omicron, we feel like we've come out of that, but we suppose are on notice, everyone is on notice that there could be other strains and variations of that. But we are seeing this return to work, and it's interesting, I would say, that a lot of CEOs now are coming out and saying, okay, we want people back in the office. And I'll talk about what does that actually mean? Is it full-time or is it hybrid? High vaccination rates, this has been great, masks off, and that's been a big benefit for office markets as well and the return to work. The Australian economy has performed well. I'll touch on this in a moment. And on a global basis, relative basis, we also have performed well. And the Australian government, personally, I think has done a good job in terms of actually supporting and underpinning through the COVID experience. We are starting to see, obviously, the talk of the town is inflation, and we saw cash rates increase last week. And what does that mean for values? I'll touch on some of that because we've had record low interest rates. So I think it's fair to say we are moving to a more of a normalised level of interest rates and inflation over the next few years. We've seen record transaction levels, and that's amazing considering where we've been in COVID. But I'll talk to you in a minute about some of the equity raising as well, and a few slides later that we've been able to see. So commercial transactions have remained strong through the last sort of 12 months. So what are the big features of 2022 and beyond that we're personally thinking about? One is what happens with interest rates and what does that mean for inflation? And what does that mean for the structure of our portfolios? Is there any change that we want to see? At the moment, we've got very strong fixed increases running through our office portfolios. They average around sort of 3.5% per annum. And we have a very long weighted average lease expiry profile. So we're just looking at that and we're very comfortable with that is. But there's some of the the strategies that we're thinking about. You can see up there that we're expecting to see more geopolitical tensions, and that is unfortunate, but it is the situation we have. The Ukraine, what's going on with China, further lockdowns in Shanghai, how they manage COVID in that environment will be interesting. And it could obviously have more supply constraint issues for us. Supply constraints mean increasing costs, particularly when you're developing. And so that's something that we will be watching over the next few years. And of course, the other negative impact of all of that is it makes stock markets quite jittery, and we'll talk about that in a later presentation today. But you would have seen that global growth has come off on the back of some of those. So one of the other big things that we always have our eye on, of course, is demographics, changing, ageing population, the importance of some of these key themes, particularly I would say an acceleration of this concept of well-being, and the war for talent. And what does that mean for corporates, and how are they addressing that through their real estate accommodation strategies? And there definitely is a lot of talk from all of our tenant customers in this space, and I'll unpack that a bit as we go on. And ESG, environmental sustainability, it is absolutely a hygiene factor for us now in real estate. And I would say the Australian real estate market, and a lot of our competitors as well, are global leaders in this space. So just quickly onto the economy. It's performed well through COVID. And obviously leading into COVID, we're in a good position, 29 years of growth without a recession, which is a global record. The two charts here, the chart on the left is showing the change in growth in GDP on a cumulative basis since 2019. And what it's really just pointing out is that Australia has outperformed some of the leading countries in the world in its recovery coming out of COVID. So that's once again putting us in a good position. And then the slide on the right is really looking at, on the horizontal axis is economic growth, and on the vertical is population growth. And it's saying that Australia, under those two metrics, is well placed in that top right-hand quadrant around the world. And that is important because in the, standing back from everything, population growth does drive underlying GDP growth. And so we feel that this is one slide that I would be putting up to most of my international investors when they're coming to Australia. They want to see what is the population growth, what is the sustainability of the returns. Strong recovery in labour markets. I think my slide is sort of like edged to the right for some reason, my line, but obviously unemployment rate is very low, the lowest since 1978. It's a fantastic place for us to be in. But that war for talent is real. And I would say, obviously, we saw last week that the RBA has got its eye on wages growth and what that means in terms of inflation as well. So that's something to watch. But this is another reason why we're seeing particular behaviour coming from corporates and CEOs, which I will unpack. Okay, this is one of our favourite slides. It's showing global investor intentions, if you like, to increase allocations to real estate. And this is Asia-Pac real estate, so the whole Asia-Pacific region. Now, typically, you would see Australia clearly in that top 10 and office. And what's happened is during COVID, with all the discussion on what does it mean for hybrid working and working from home, that basically slipped out. This is the most recent survey, and what we're seeing now is investor intentions are to come back, and Australian office, particularly Sydney CBD, is back in that top 10 investment destination. And we have seen in the last 12 months close to 17 billion worth of office transactions in Australia, and that is above the average, which was around 15.6 billion. So we are expected to see this flow of capital coming from offshore continuing for some time, and they're estimating that real estate allocations would increase by about $100 billion just in 2022 alone. This really is, I suppose, one of the key points that I would talk about here that demonstrates this impact for us is our most recent equity raising. So we opened up an equity raising in one of our large wholesale funds, which is supported by all the big superannuation funds and global investors. And we have raised close to 700 million, and we would expect to raise up to $1 billion. And I think standing back from that, it really does show you that people are starting to move on from where they were on COVID and actually see on a relative basis that commercial office is looking like a good investment, particularly in Australia, the way Australia has performed. Okay, so this is capital value growth. It's very strong. I've had great, obviously good liquidity, lower return hurdles, and a very supportive yield spread to the 10-year bonds. So it's actually been, a good time for buying assets, and we've seen good capital value growth off the back of that. And this just shows basically the CBDs are all the different lines, the top line being Sydney CBD, and you've seen that acceleration in values, particularly over 2020 to 2022, which are the last two data points if you can't see those. The other thing that this is prime values, and it illustrates that there is really strong demand for high quality assets in good locations that offer very good amenity and the ability to offer a great experience for tenant customers. Last year, across the Charter Hall office platform, we saw an increase in net increase in valuations of around 6.5%. And, that was a great result. And in fact, we will see on DOF and PFA, we saw a slightly even higher capital value growth coming from that. And that is really about those assets that have long-term leases, those sort of fixed reviews, high quality tenants, experienced very strong capital value growth over the last 2 years. And we're in strong demand from international investors coming in to acquire them, but also superannuation funds and funds like ourselves looking to acquire them as well. So I suppose one thing to watch, we'll continue to watch what happens with interest rates and bond yields over time, but we would expect to see very strong performance, holding performance in terms of the capital values for prime. What we are seeing is a differentiation in the market starting to emerge between secondary assets and prime assets. And there's one big thematic that we'll touch on now, which is really there's an upgrading of quality going on with tenants. Tenants are moving from secondary assets into prime assets for various reasons. And that will have an impact, you would say, or should have an impact in sort of secondary stock over time. So how has Charter Hall's portfolio gone through that? I could throw up about 60 charts, but Steve's given me only 15 minutes. So I thought I would use this one as a bit of a talking point. This is just showing you Eastern Seaboard, Charter Hall platform, vacancy rates versus the market vacancy rates. And obviously we have been really resilient through the last few years. And it has come from hard work in terms of looking at the lease expiry profile. We've had active strategies to extend lease expiry profiles through this period and make sure that we're nursing our customers through this period. We have been very loyal to our tenants, and I think that has actually put us in a good position. And as Steve mentioned before, we really haven't had to give a lot of rent relief. And I'll touch on how much that's been, which is quite minuscule actually. So really two things to note about us for COVID. We're in a strong position. We have had these active strategies. And the second one is, from a market point of view, the Australian office market entered COVID in a very strong position. So our total vacancy rates nationally in Australia was sort of around that sub 5%. And that provided an enormous amount of buffer to what happened during COVID. When people started to pull back and work from home and sublease started to come onto the market, we actually saw, yes, an increase in vacancy, but because we started at such a low point compared to other markets globally, we sort of have weathered that storm very well. And in fact, so if you look at where vacancies are now in Australia, they're sitting at around 12% total vacancy. And interestingly, we have seen sublease vacancy, which was the one that rose quite significantly through COVID, halve. So it's now 50% less than it was sort of 18 months ago, and it's coming back quickly. I think the only factor that would slow that down now is if we had another variant and another lockdown and people were at home. But that feels like that's a very good result. In terms of Charter Hall's numbers, our rent collection is at 99% and basically sort of stayed through COVID. The number of defaults was very low, 0.14% of gross income. and our rent relief was only 1.2% of total rent across the whole portfolio between March 2020 and March 21, which is when we had to give the government rent relief. So that was another good result. Steve used this slide, but we love the office slide. It basically is showing you here that this is an important strategy. I joined Charter Hall 18 months ago, and I would say the focus that we have on customer here and tenant customer, repeat business, and trying to really deeply understand what a customer is doing has put us in a great position through COVID. And you can see here that 65% of our top 20 tenants are sort of names that everyone knows in this room. It's global names and domestic names. And importantly, 30% of our portfolio is government tenants. And this has been a clear strategy of Charter Hall, and that started around sort of 7 to 8 years ago, and they've stuck to that strategy. And it provides a fantastic foundation for office portfolios, for us to build our portfolios, because we can basically have a large proportion of government tenants within a portfolio, get that strong covenant, and then from there we can start to build the portfolio to take, potentially more market risk in some markets, and that's how we actually build the portfolios up. So this actually also led to pretty strong capital value growth over the last few years as well. So here is probably, I would say, the most pronounced thematic through COVID for office markets. What we're seeing is a flight to quality, and this is really showing it. This is showing you the change in occupied stock way back since 2000, and as you can see, goes up to 2022, but you can see that is really starting to separate now. That is a divergent strategy, and that's secondary stock and what's going on in prime stock. And we had 498,000 square metres of take-up in prime stock over the last 12 months and negative 100,000 in secondary. And so for us, this means that we have to be really disciplined about what we're owning and what we're selling, and how we actually are looking at cash flow and where we're spending that incremental dollar in terms of making sure we're getting the right returns, but investing it in the prime assets so that we can actually meet the market and what the market's looking for. So I suppose the view would be that we're going to see an acceleration obsolescence in secondary stock in a lot of markets. So how does that activity translate into rental growth? So what we saw through COVID was an immediate reaction to everyone's working from home and no one could see past 12 months. And so to encourage people to move and take office accommodation, we saw incentives rise. So when you do a leasing deal, you're getting a rent, you pay a rent, and generally you'll get an incentive of some sort in Australia. And that could be months rent free, it could be capital to do a fit out for your office building. And we saw that rise as a proportion of the rent. And now we're actually seeing that stabilise and we're seeing it come down. And for good quality stock in CBD markets, that's coming down. It's probably never got to the levels obviously in some areas, but it's actually starting to come down. And so that is what's driving. You're getting small amounts of face rental growth now, but you're really seeing the impact of incentives coming back. And that's going to drive rents over the next 3 years. Interestingly, here is Canberra, way out there at sort of 10%. And this is my learned colleague's forecast over here, so Andrew. But what that's really showing is vacancy rates in that market are down at very, very low levels. So around sort of 3%, the vacancy rate is in Canberra at the moment. And so that's why you're seeing that rental growth, effective rental growth, so strong in Canberra. And we obviously have been acquiring a lot of assets in Canberra. We've been going we're very interested in that market because we can get long leases, brand new assets, fixed reviews from the government, and we like that. That's a really good cash flow for us. Okay, so who's actually, where's the employment growth happening? No surprises here. Financial and insurance services, public administration, those sort of areas have been growing over the last 2 years. And then when we think about what's happening now, we're seeing quite strong growth in public sector activity. Another reason why we like government tenants, but a lot of activity in the public sector. Areas like defence. Last year in particular, we saw cybersecurity as an issue, and we had requirements coming through from the federal government for additional space, significant chunks of additional space to house those type of departments. So there's been public sector, healthcare, technology companies all expanding as well. We are tracking leasing activity very carefully at the moment to try and really ascertain what is happening on the ground. And one of the things that we've seen, if I compare on a rolling 12-month basis, the number of leasing deals we're doing versus 12 months ago to March, we've got a 74% increase in the amount of space that we're taking. So that is a great indicator of momentum. So, we're cautiously optimistic, but that is a great start. We have to remember that we always would have been slightly lower last year or 12 months to March 21 because we're in COVID. So that's just, be careful of that stat. But that is above where we would normally see our rolling averages on a normalised year. So that's very strong. So there's a bit of catch up going on and people are going back to the market to do deals. Looking forward on the bottom line there, we are also tracking, there's 309 briefs out nationally in the market at the moment, and they're covering around 1.5 million square metres. So obviously we won't be the beneficiary of all those because we don't have that vacancy, but that is another good indicator. And the interesting thing is that last year the public sector was dominating. This year we're seeing more private sector tenants coming to the market, which is positive. 3 points here that I would make on those trends. So the first slide on the left, very simple, it's just basically showing that those tenants under 5,000 square metres, this is a CBRE data from their leasing deals that they're tracking, have seemed to be, on average, have expanded. And tenants who are greater than 5,000 have contracted. Now, people talk about this, but it's actually good just to look at the stats and analyse every single leasing deal to get to the bottom of that. But that is an interesting one. And if you look at the middle chart, it's just basically showing, okay, so where is the activity? And it's showing the number of deals are under 5,000. So smaller companies have been very active. And when you think about CBDs in Australia, particularly Sydney and Melbourne, 60% of the tenants in those CBDs are actually under 1,000 square metres. They're not the large, so yes, large tenants and big names on buildings take up a lot of space, but a lot of this activity, interestingly, post-COVID is coming from the 1,000 square metre mark, which I think from a health point of view of the economy is a really good space. And we're seeing them take space very quickly. The other interesting thing is larger tenants on balance are prepared to have paid more rent. So although they've contracted, their rental bill is slightly going up, which obviously says that they're prepared to pay more for the right type of asset, but they'll contract to get into it. Here's some strategies that we're seeing driving markets. Some are in growth phase, these names, some of the boutique investment banks, technology, health, expansion mode, Amazon, government, contraction mode, have been in contraction mode for some time. So a lot of the banks have been looking at their space requirements for the last 15 years. I worked at the Commonwealth Bank when I first started working for 10 years, and I was working in property there. And we were already thinking 20 years ahead, what was our space requirements going to be? So some of these strategies have been there for a long time. So then what does that mean for the key thematics that as a business we need to take into account to actually continue to actually outperform? There is no doubt that we believe that office will remain a key part of any ecosystem. Most companies see the office, coming back to the office, is the place that they want to do bulk of their work, but they want to change potentially the way they're using it as well. So we're seeing a lot more thought going into collaboration, the way their space is laid out. They may not have as many fixed desks, but they want more meeting rooms, so that's sort of happening. And then there's these things that they are asking us. And if you're not offering some of these things now, these are hygiene factors, you just simply on large tenants will not get approached, which is, I think really that's probably the big change. So first one is, touched on this, the upgrading of quality. So high quality accommodation is where most of these large tenants and middle-sized tenants really want to be. And you can see here some of the big tickets and the big names that are actually moving around. So Having a development pipeline has been really important for us, and being able to create some of this space for them. But also when we look at our asset management plans, making sure that we're taking our existing assets that are really good quality assets and making sure they're going to remain competitive in their market is really important at the moment. And you can see here some names like UBS, Amazon, the Australian Federal Police, CBA, BHP. They're all tenants that we're currently have been working with in terms of briefs out in the market. Flexible space, the other key area that everyone's talking about at the moment. Tenants want more flexibility, and there's two areas that they're looking for it. The first is they want flexible space in their buildings. This is nothing new, and this slide here is just showing you that in 2017 we came up with our first flexible space option, and it's been an evolution since then. And you can see right out to 2023 we're going to continue to evolve and have the next generation of flexible space. So a good example of this is BHP. They currently have been in the market over the last few years, very advanced in their space requirements, looking at, I want this much core space, but now actually I'd like 3,000 square metres of flexible space. Can I have both? And so some of the things they would have traditionally had in their core space, they now have in flexible, and they'll pay as they need it. The second one is flex and handing back floors or expanding floors in the future as well. So that's probably the next area that we're seeing. This is just a range of space requirements that you can get when you flex. So it's an ecosystem, if you like, of different flex strategies. It's business hubs, it's fitted suites. It's not just one thing. And every asset has a different requirement. The third is employee wellbeing. The brand and your real estate now go together. So companies want to make sure they're associated with the right asset and it reflects their brand and purpose. And also that employee retention is critical, so that we're offering the most rich amenity in our buildings and experience as well. So we're certainly looking at all that, and we've seen further advancement in wellness as well. And this is just showing you some of that evolution in that area. ESG, this just gives you an idea of the type of things that we're doing on the ESG front as a business. But this is where it really matters. So this is, when we talk about sustainability, this is just 3 examples, which I won't go into, but I'll call out one, which is 60 King William Street, where we're trying to ensure that we're giving our investors sustainable returns over long term, and we're actually meeting tenant customer requirements. So here you've got a carbon neutral building. The first carbon neutral enabled building in Adelaide is being developed by us. And you can see some of the names here that we're working on in these types of assets. If we didn't have these ESG strategies, these tenants would not have come to us. Simple as that. And then, of course, the smartest office buildings. The first thing we saw here was hygiene factors. During COVID, we had to go to touchless. We had to retrofit everything with touchless bathrooms, doors, everything, including car park number plate recognition through our car parks. All of that had to happen in the space of sort of 12 months. And you'll continue to see this. So getting data is going to be important for us, particularly to drive occupancy costs down for our tenants as energy costs and so on increase. So in summary, there's really 3 key areas I would just like to leave you with. One is the return to office continues, and we are seeing momentum, and so we're cautiously optimistic. There's some really good things happening in the market, and that will support capital growth and a lot of the leasing activity. Secondly, prime quality assets, you need to make sure you're very disciplined on that strategy, and we have been. Prime quality assets, we are likely to outperform secondary assets, particularly with some of the strategies we're seeing. And the evolution in the workplace has continued, and some of the things I just spoke about, those 5 key thematics, will continue to be things that you'll see into the future and will be critical if you're going to be attracting the right tenants and underpinning performance. So I'll leave it at that. Thank you very much. 30 seconds.
Thanks, Carmel. And it's really good to hear from someone that's across the detail and not just talking about how things feel like or we think they go, but looking at the data and seeing what are the trends that we're seeing across such a wide, diverse portfolio. It's also great you can tell Carmel's so passionate about property. I'm sure she could have spoken for much longer, but I've appreciated, and I'm sure you have, her insights into the office market. Look, I'll now welcome to the stage Andrew Ballantyne. Andrew is the Executive Director, Head of Research of Australia for Jones Lang LaSalle, where he manages the largest and most diverse property research team in the country. In his role, Andrew participates in a range of initiatives, including market analysis, forecasting, research, client engagement, thought leadership, and product development across commercial, residential, and alternate real estate sectors. Very busy there, Andrew. I like it. Andrew is an experienced industry researcher with over 20 years of experience across the property market. Please do welcome to the stage Andrew Ballantyne.
Thank you, Steve. Thanks for the introduction. I was a little nervous if Steve was going to go through it line by line, or he was going to say something there about how busy I am. Clearly, there's a team of 27 of us across Australia and New Zealand doing a lot of those activities. But it is interesting that I've got the industrial and logistics and retail sectors to cover, because both of those markets have arguably never been more interesting. And the theme that I've gone with for this presentation is, how do we interpret the signs for the commercial property sector? And you can probably tell by my accent, I grew up on the west coast of Scotland, and the only interesting signpost we ever had was one of be aware that there may be a deer crossing in this area when you're a forest. So that's one of the great things about coming to Australia. I can be much more creative with my opening slide with some of the signposts that you have around this country. But what's interesting when you sort of think about it in that context, I thought Carmel gave a really insightful introduction to the economy, and there's certainly things that we're looking at. But I've noticed as an analyst, we're looking broader and broader at the signs to try and give us insight into where the economy's trending. You know, a few years ago, no one was tracking port congestion statistics. Now most people can actually quote how much of the fleet is actually tied up in port congestion, anywhere between 4 and 8% of the time at the moment. So one of the challenges that we're doing in terms of how we're picking back or peeling back the layers of each of these sectors is, what are some of the unique indicators that we should be looking for that actually give us guidance, but also at the same time, what if those indicators are actually rubbish and we should be staying away from in terms of how we actually formulate our own views? Now, when I talk about the industrial and logistics sector, outside of the day-to-day that we'll cover in a moment, there are 6 key themes that we're looking at. And I know when you look at that first image around consumption patterns, you're going to be sat there going, he's going to tell us that the online retail penetration rate has gone from sub 10 to 15% through the COVID period. Yes, that's a tailwind, but I think there's an interesting story happening behind the scenes that is capturing less attention. And that story is Gen Z and millennials becoming a larger part of the consumer market. And they consume with more of a social conscience than what we've seen from previous generations. And that sort of flows through to what we're seeing around supply chains that we're going to touch on in a few moments' time. But if you look at retailers that do business in California, every single one of them is covered by the California Supply Chain Transparency Act. And that doesn't just cover modern slavery and other factors, it covers every aspect of the supply chain. So retailers, in terms of how they're doing their business, is different, and that's having a major impact in terms of what they expect from their logistics providers. Now, if you look at the one on the far right there, yep, got it right, the right way around, inventory models. We've heard a lot of discussion around it not being just in time, but now just in case. I was at a supply chain conference about 3 or 4 weeks ago, and it's interesting when you look through the lens of someone else, and they actually said that a perfectly efficient supply chain doesn't actually require a warehouse or a distribution center. It's actually a negative externality of their view of inefficiency. And it's all made me think when you think about that journey, but you go, we're seeing more inefficiency than we've ever seen. We're seeing big shifts around where product is likely to be manufactured or stored. So I actually think those inefficiencies are becoming greater. And even when you speak to people in that industry, they're now seeing that as well. If we're moving towards an instantaneous delivery model, the role that warehouse distribution logistics facilities have is even more important than where we were. And then how those organizations are using that space. So when we talk about warehouse automation, everyone thinks about what the big supermarkets and Coca-Cola and some of those other big retailers are doing. There's a lot of groups that are exploring partial automation. So what can we do around barcode labels? What can we do around automated guided vehicles around the facility? So for a lot of organizations, it's only that partial implementation rather than a full-blown implementation. Now, Steve and Carmel both touched on it around ESG. At JLL, we now believe that every real estate decision is being viewed through an ESG lens. And I think it's important then to look through that lens in terms of what that means. So if we think about it in the context of the industrial and logistics sector, we would argue that Australia is world leading in terms of how we've designed, construct, and managed our facilities. But we now need to start to think about the S aspects. So socially aware investment, which has been driven by a lot of the European funds. Who is the occupier of that space is getting a lot more attention. But also from a workplace perspective, now this is a little bit tongue-in-cheek, but I was speaking to one of my colleagues and he said, you know, 5-6 years ago, Andrew, it was all about the quality of the bacon sandwich that you could get out of the caravan. Now you actually look at some of the other features that are in there. So wellness areas, fitness areas, much more innovative F&B offering. That's all part of the S aspect of ESG, and it's only going to become more prevalent moving forward. And we'll touch on asset allocation and pricing towards the end of the discussion. Now, when you look at our numbers in 2021, you can see it was an all-time record high for the take-up of industrial and logistics space. And while e-commerce was clearly a tailwind there, the story was much more diverse. We saw growth from 3PLs. We saw growth from manufacturing. We saw growth from food and other retailers. We saw the reversal of the lean inventory model that we've just touched on. And we also started to see growth from the healthcare sector. When you look at our forecast for this year, it's actually down slightly. It's not down slightly due to lack of demand. It's down slightly due to lack of space availability. Across the eastern seaboard, we're in an environment of sub 2% vacancy. Now, it's all well and good to think about, look at the economic variables. They're all generally positive for the sector. One of the things that JLL did last year is we did a global survey of market participants, and we asked them, what geographies do you expect to see significant growth in demand? And by significant, we're talking 15 to 20%. Guess who was number one? Australia. So while we see phenomenal growth here, we're actually lagging a lot of the trends that we've seen in North America and Western Europe, and we'll certainly touch on that. Steve actually missed a very important part of my job in the introduction. I was given New Zealand to cover a year ago, so I always have to say something about them in a presentation. So this is my New Zealand tick. They actually came in at number 5. So they're actually lagging some of the trends that we're seeing here in Australia at the moment. And not unsurprisingly, when you go through industry sector, e-commerce retailers is the strongest. But as I've said, if it was just an e-commerce story, the market wouldn't have the strength and diversity that we're seeing at the moment. What we've classified express parcel delivery, third-party logistics, health and life sciences. Life sciences is a really interesting one in an Australian context. If you look at the amount of space you have per capita in the US and apply that ratio to us, we're 750,000 square meters below where we should be. Now, while we can debate around venture capital systems, the fact that we don't have a lot of homegrown organizations in this space, this is a growth area, and we're coming from a place of undersupply. So let's start to think about some of these sectors individually. And when I think about retailers, I borrow the Boston Consulting Group classic retailer business model. So for the longest period of time, retailers were fixated on their value proposition, and they still are. And for those of us that have studied Michael Porter, we can see this coming through pretty strongly. Product and price is how you differentiate. That expanded into the service element and also the shopping experience. I think as it relates to the logistics sector, the operating model that we didn't spend a lot of time on is becoming much more interesting. And when you start to look at retailers and how they're evolving their business, you're seeing this come through strongly. So Everlane are the poster child for transparency in supply chain. This is actually an image of their factory in Brazil, but what they do when you buy their product is they give you a detailed breakdown on how everyone is compensated. You also, when you go on their website, they give you detailed images of everywhere their product is manufactured, and they also tell you about their quality assurance program. That was largely driven by the work they did in California, that they knew they had to be a first mover or an early adopter, and they knew that this mattered for millennials. And we're seeing that come across a range of different retailers. So Kings of Leon are a band, Kings of Indigo. Apologies for that, I should have brought notes. Generally in presentations, I've got 3 issues. Ones that come out my mouth and a little typo in the slides to show that I do my own material. So that's number 1. The first person to find 3 put their hand up. So Kings of Indigo, not Kings of Leon, they talk about their 5-step sustainability process. But they've also embraced in technology because they're worried about greenwashing in the supply chain. And they want to strip out that greenwashing that exists in supply chain to show true transparency. You then have groups like Citizenry. They talk about the partnership model that they have with their craftspeople. They talk about what they did during COVID around the education on health, and also what they did around actually providing forward payments. And then the last group, and given that I stuffed up Kings of Indigo, this one I'm definitely going to make a mistake on. This is a Japanese group. And essentially, it's all about renewable material. So they talk about it's all organic, and all the material is sourced, is either recyclable or has the potential to be renewable. So when you look at those retailers, you sit there and go, their product maybe isn't that differentiated, but how they make it and how they get it to you is highly differentiated relative to their competitors. Then have a look at the manufacturing sector, and you look at the numbers and say, the ABS tells us we've lost 64,000 manufacturing jobs since 2015. Now, part of this has been the automation story that we've seen within the sector. But when you look at some of the industry subsectors, you see the growth as it relates to metals, minerals, but also even furniture. This one actually surprised me until I spoke to one of my colleagues, and he said, people don't have the desire for product to be delivered instantaneous as it relates to furniture. So given how tight Sydney is, he's actually been showing them new development opportunities in Melbourne. And yes, you'll have a longer journey time to your customer, but the rental costs in Melbourne are more affordable. So you have to ultimately run that equation. The other big growth areas as it relates to food. And I think that's a fascinating area when you then expand it into what the Commonwealth of Australia has touched on as our sovereign manufacturing capability, with F&B up there in the top right. I was looking into it recently and wondering, I know Australia is a food bowl, but how much food do we actually export? And you can get the numbers. Then I actually found another study that translated it into the average calorie intake of someone in Asia, and it equates to 77 million people. That's a phenomenal number, and something as a country we can obviously be very proud of. If you actually use the average calorie intake of an Australian, 63 million, a little bit lower, and probably says when I look down and think as I hit into my 40s, maybe should focus on that diet a little bit more. But there's other interesting areas that are coming through, clearly around recyclable and clean energy, but also defence and space. You know, defence has been a big growth area that Carmel touched on in the office sector. That's having a broader impact across sectors. And the other point that's probably worthwhile raising as we touch on F&B is when you look at Australia's amount of cold storage facilities, on a per capita basis, we're less than other mature economies. So we've still got catch up there in that important growth sector. Now, when you think about health, and apologies, I've brought the more benign, boring version. I was up at the API on the Gold Coast recently, and I decided to do something different in terms of how you look at the growth trajectory in health. The one thing even I, as an analyst, hate is a chart that starts in the bottom left and goes all the way up there to the top right. So I'm trying to be more creative. Up on the Gold Coast, I actually looked at who held state of origin over 10-year intervals, and the answer was Queensland all the way through. So this time I've been a little more boring. So in 2000, there were 19 million of us. 2.4 million were over 65 years old, or 12% of the population. You fast forward, to where we are today, 26 million of us, up to 4.2, and then look at the projection through to 2050. And I get this is something we all know, but sometimes when we pause and look at those numbers, almost 20% of our population, and by 2050 I will be in that cohort, 7 million over 65 years old. That's a significant tailwind to the health sector more broadly. But also coming through COVID, there's a lot more discussion around how do we actually manufacture medical products? Where do we store them? And also as it relates to pharmaceutical. And then when you say outside of people over 65, the reality is more of us consume pharmaceutical products during our life than we've ever done before. So there's a growth story there as well. So this is a massive growth area that we're only starting to see, and this impacts all sectors. So how do we think about the underlying demand story from an asset creation perspective? And one way that we've done it is we've simply looked at, for every head of population in Australia, you need 4.5 to 5 square meters each. And Carmel touched on it around population growth, looked very attractive relative to other mature economies. So under that base case assumption, somewhere between 7 and 8 million. What we're seeing at the moment is a structural change for a period of time as a result of e-commerce. This isn't unprecedented. Go back to 2001 when China joined the WTO, this ratio jumped. And it jumped for a number of years while we went through that structural change. So what we're saying is this ratio could easily be running 6 to 6.5, which says that the underlying asset creation is somewhere between 9.5 and 12 million, depending on your scenario. And from an ESG perspective, and this is a US example, there are 19 points as it relates to sustainability. And we obviously see a number of those features in our own geography with solar paneling, water harvesting, the types of materials, LED lighting, electric vehicle charging. But as I said earlier, watch for the evolution of the social aspects. That, to me, is going to be the interesting part of this sector. Now, I started in JLL back in 2007, and I never thought in my career I was going to have a chart like this up here. This shows industrial and logistics rental growth over the past 12 months. I used to be based down in Melbourne, and never did I think I would be telling you that over the last 12 months, rents grew by 15% in Melbourne's west. This is very low space availability and very strong demand fundamentals that we're seeing. Now, when you look at these numbers, for certain geographies, you would argue they're eye-watering. This is actually conservative relative to what we're seeing in other mature economies. Now, apologies for putting someone on the spot. Does anyone want to guess what Toronto logistics rents grew by over the last 12 months? Any number? Sorry, Carmel? 20%, good guess. 30. And Montreal and Vancouver were 28 over the same time period. And this is just the spot number. Since 2016, Toronto has doubled. So we look a lot at other geographies overseas because, as I said earlier, we're lagging that story. And what we're seeing is phenomenally strong rental growth. And then you start to think of the cost part of the equation. This is an index back to 2010, and I get I'm using a period after the correction from the financial crisis. Service land values in Sydney, Western Sydney over that time period have grown almost sixfold. There has to be cost push inflation coming through. Land values, material costs, labor costs, financing costs. Even speaking to a builder last week, he was saying, middle of last year, it cost me about $7,750 to build. I'm now $9,950 and going up. So that cost push inflation will ultimately lead to higher pre-lease rents and drag up existing assets even further. Now, one of the things that we do is rather than just put our spot forecasts up there, we also like to hide our forecasts a little bit, is we've looked at what an organization would see if they've assumed a 5-year lease term. So if you signed up in 2018, you had fixed escalations, you're facing a 20% reversion on our figures, 20 to 25 and 23, 24. Now, most groups, when they look at this, go, Andrew, you're being your classic researcher and being conservative. It's actually going to be stronger than that. So we're having debates around how significant that reversion will be. Just very quickly in terms of then how we interrelate logistics to the retail sector, to me the link comes through Q-commerce. And while we're all very fixated on e-commerce, Q-commerce is essentially the move towards an instantaneous delivery model and the ability to deliver product within an hour. Now, we've done some research to say, well, where do we think Q-commerce is going to be seen first from a demand perspective? And we looked at LGAs with a high proportion of people aged 20 to 40 and high income levels, and saying ultimately that's where we'll see it. Then we start to think, well, what does this mean in terms of product? And we've had, as a family, a couple of Q-commerce experiences recently. Our little Griddle, which is 15 months old, my wife broke its harness. Within an hour, the product had come from Pet Barn and been delivered actually via Uber, who are now partnered with them. We had another Q-commerce experience with the same delivery model with one of the supermarkets, and it came 4 hours late. So yeah, I think that Q-commerce piece is fascinating, and that's where it flows through to how do we think about what that means for retail. Because clearly when you look at vacancy rates, we have seen significant pressure for CBD assets. They escalated through the pandemic and have remained at relatively elevated levels. So we need to see a return in workers, we need to see a return in residents, international students, and also daily visitors to improve that catchment, to see that improvement in CBD. Once we look outside of the CBD, we tend to find that neighbourhood shopping centres have been fairly resilient. Yes, vacancy is a touch higher than the long-term average, but you always have to look behind the headlines when you're looking at retail vacancy rates. And when you look behind the headlines, you see some centres which have, quite frankly, too many specialty tenancies for their catchment. You see others that have supply pressures. And you have some developers that, again, have pushed the number of specialties to support their feasibilities. If you look at large format retail, this market's getting really tight. And that's a really interesting one when you start to think about it from a development perspective, because there's very little new supply coming into that market. And speaking to one of the groups that operates in that space, they said to me, Andrew, over the last 4 or 5 years, we've sort of benefited because there's always been a few organizations in our sector going out of business, and we've been able to take their space. That's now no longer happening, and you're now not getting new development in it. So they're now challenged in terms of how are we actually going to grow our footprint based on our current vision or strategy. Now, apologies, I'm kind of running around here because we've got a timer down here, and I've now lost all ability in what that confidence in what that timer's saying. So if we look at the transaction markets, I think Carmel and Steve both touched on it. It was an all-time record high last year. And what was interesting with logistics is it was clearly off the charts in terms of activity. There was still capital wanting to deploy into the sector, because we've often argued that the barriers to entry are actually quite low within the industrial and logistics sector. There's a lot of groups that can buy an asset of 20 to 40 million. The barriers to scale, however, are significant. And most groups that we speak to say, we're trying to find a pathway towards a portfolio of a minimum of 1.5 billion, because then we can start to generate the network effects and also see higher tenant retention. Interestingly, in retail, we actually saw a record year for retail transaction volumes. So those smaller convenience and LFR centres continue to trade, but we started to see a thawing in liquidity at the larger end of the market. And when you look at the trends globally that we're seeing, you can see the portfolio shift coming through. So logistics that was about 10% of volumes up until 15 has now jumped to 20. Retail and office as an overall share has come back, but also globally when you look at it, the living sector, and this is largely multifamily in the US, has become a larger part of the market. Now, when you look at retail specifically, there's a bit of layers that you need to peel back, because most of the groups that have divested either regional or sub-regional shopping centres are saying, we're trading at book value. If you actually look at the analysis relative to peak book valuation, you can see that there's been, that's where you see the reduction in asset values at around 15 to 20% through the cycle. When you look at neighbourhood and LFR, you don't see that. And what we saw trading last year is most assets actually trading at a small premium. So not only do we have confidence in the valuations, but it also tells us that given the investor competition, they are willing to pay slightly more than published book values. Now, I think Carmel actually had a variation of this slide in her deck, so I'll just briefly touch on it. Australia is very well positioned due to two major themes: higher allocations to real assets from pension funds, the sovereign wealth funds and insurance firms, and a portfolio tilt towards the Asia-Pacific region. And then when you look where that capital is going to be deployed in the ANREV survey, look at their top city sector combinations. Australia and Japan account for 9 of them. Only Seoul Logistics jumps in there. So even though we're the 2 lower growth economies in the region, due to high transparency, low volatility, we get a disproportionate amount of capital that is invested into this region. And then just lastly, the big question around inflation, interest rates, bond yields, and what that means for real estate asset pricing. Now, we've used discount rates here as our proxy, given that they're used in the discounted cash flow valuation and are generally a proxy for returns. And as you can see, there has been a fairly high degree of correlation between discount rates and bond yields. Now, what's interesting is property market discount rates didn't chase bond yields down to the same extent. So 12, 18 months ago, the implied market risk premium was wider than historical benchmarks. So investors were taking the view that we were going to see an increase in bond yields. Their view was generally that we're going to 2.5% to 3%. Now, we've obviously on a spot basis moved through that, but when you look at most of the projections from economists, they're generally saying that once we start to go through some of these supply side constraints, we will move back to somewhere between 2.5% and 3% as your long-dated bond yield. And it's actually interesting when you think about that number. The long-term spread between the cash rate and the 10-year bond yield is about 60 basis points. I can't really see the RBA going too far beyond 2% to 2.25%, given the impact that that would have on the Australian housing sector. So thank you for listening to the 4 chapters of my presentation this afternoon.
This brings me to my part of today's presentation, where I'll give an overview of the direct suite of funds. So this chart up here on the slide shows the blue bars representing Charter Hall's funds. The dark blue bar is our listed Maxim Property Securities Fund. It's highlighted differently because it is a liquid fund versus the others. Importantly, the 2 grey bars are the respective benchmarks. Every single fund has outperformed the benchmark for the open suite of funds. But to be honest, the benchmark, whilst it's great, isn't what people can use to support their lifestyle. We're focused on absolute returns. So that combination of income in the bank account and values that are increasing. Because at Charter Hall, we recognise we're the custodians of other people's capital, and we want to make sure we do everything we can to protect it. But I never, ever tell people to expect these type of returns. So I think what's much more realistic is how have these funds performed since inception. So some of these funds have been going for 7, 8, 9 years, and this is the per annum compound returns. Again, the blue bars representing the respective funds, and the grey bars, the benchmark. So similar trend, but probably a bit more realistic around the return profile. And as I said right at the start, unlisted property, you should think of it as an 8 to 10%. And at no point will you ever hear me say to expect the level of returns which we've been able to generate. So moving through to what we call fixed life funds. These are funds that aren't available for investment. They are closed. They have outperformed the funds that are open largely because they do have higher gearing levels. And they have that because that's what we told people we would do in the original offer documents which we went out with. So BW, DIF2, DIF3, again, very similar trend, significantly outperforming the respective benchmarks. So I will cover off on the fixed life funds. There probably aren't as many investors in these, so I won't spend too long on it. But the BW Trust, if you came in and invested at the dollar, it's now worth $2.82. The occupancy rate, you can see, is exactly the same across the 3 funds at 100%. Similar thematic around long-term leases, which have underpinned the performance. And what I should point out with these funds is that they have set review dates, points in time when we will wind up the funds and return capital. So the first is DIF2, which will happen in Q3 this year. We've actually extended that fund as long as we're allowed to under the PDS. So what we'll do is we'll write to investors in this fund, and we're looking to provide them with an option to stay invested and get exposure to industrial logistics, or a cash out facility, and let it be completely up to the investors or their advisors to decide. And DIF3 and BW, well, they've got further dates further out, And again, just keep an eye out. We will write to you as they get closer. This now brings me to the first, what we call open-ended funds. So the way we've set up the funds is you invest, and then at 5-year regular intervals, we do a liquidity event. Not subject to unit holder votes, nothing tricky. We simply write to the investors or their advisor and say, review event's up, you tell us what you'd like to do. The PFA fund is a little under $2.5 billion. And drawing out that theme which Carmel spoke around, the top tenants, you can see here that the federal and state government comprise over 60% of the net income in this fund. It's not an accident, very deliberate, and it's a great result for investors because government entities, whether federal or state, have the best tenant rating and best financial strength out of anyone. The weighted average lease expiry for both of our office funds, and I'll come to the other one shortly, around 7 years, and the occupancy rate at 99% exceeds the PCA benchmarks across all time periods. Around 75% of the assets that we own are in that eastern seaboard market. So that Brisbane, Sydney, Melbourne. Sydney and Melbourne are classified as gateway cities in the world stage. What does that mean? It simply means that they're deeper, more liquid pools of assets. And when we're buying assets, we're not just looking at the entry. We want to make sure that when we think the risk-adjusted returns have been maximised, we can exit people. So Sydney and Melbourne are typically the first jumping off point for some of those world's biggest wholesale investors when they want to get office exposure into the Asia Pacific. And you heard from Andrew around the health and social infrastructure. At Charter Hall, we now have $1 billion worth of higher education. And one of the things which I think the team have done very well is we've looked through some of that short-term noise. We've all seen the statistics where the international students dropped off, along with all immigration, as the government protected everyone by shutting the borders. We've been able to unlock a number of great acquisitions in that time and on long-term leases. And the other thing people don't often realise with some of these large universities, as an example, they're very well capitalised. They have a lot of assets on the balance sheet, and once the international students get back up and going, they all are performing very strong. We've targeted the universities initially that have a lower percentage weighting to that offshore tenant market. So to round it out, if you're an investor in PFA, it is coming up to its liquidity event. Probably the most common question I get asked around these is the fund going to wind up? I can assure you it's absolutely continuing. Having done this many, many times in the 12 years I've been at Charter Hall and prior to that, the 7 years at Macquarie Bank, we know somewhere between 10 and 20% of the equity base looks to exit every 5 years. Completely understandable. People have changing lifestyles. People may just want their own capital back. And what we do is we position the funds to be able to deliver that. So we will keep that window open for 6 to 8 weeks. We'll then likely get everything independently valued at 31 December to make sure that it's fair to both continuing investors, so the majority of investors, as well as those investors who are looking to exit. And we'll look to pay people back, anyone that wanted to redeem sometime in the first half of next year. So if you are an investor in PFA, do keep an eye out and we will write to everyone in the next few months. This brings me to our largest fund, which I'll talk about. The Direct Office Fund, a little under $3.2 billion. It too has the largest tenant base being the federal and state government at 33%. Similar weighted average lease expiry to PFA. The main difference between the two funds is DOF tends to target more CBD assets and has a slightly lower distribution yield. It doesn't mean one's better than the other, because in PFA we've been acquiring new assets in strategically important markets for those tenants. But what it does allow investors to do is to choose. And many investors also stagger the way they invest because the liquidity profiles aren't all lined up. The occupancy rate, again, 96% above all the PCA benchmarks. I can tell you Carmel and her team worked exceptionally hard along with the Direct team throughout COVID, and we extended leases wherever we could. So if you're a tenant that had some cash flow shortages, we'd work with you. We would give you some rental relief, but in exchange, we'd look to extend the lease terms. So creating genuine win-wins where our funds have longer secure income streams, but we help the tenants get through a difficult patch. Well, we're also in the game of providing different options for investors. You may not have a view, or your advisor may not have a view on which sector is going to outperform. You heard Andrew speak very glowingly about the growth prospects in industrial and logistics. But we've got many clients who say, well, Charter Hall, you're the experts in property. Why don't you create a portfolio that you think is going to drive the most outperformance over a period of time? And that was the genesis for the Long WALE Fund. It has a longer lease term than the two office funds, around 8.9 years, but that's still focused on strong tenant customers, government, Bunnings, Coles, Primo, ALH Group. We're currently in due diligence to acquire a new asset, which will take this fund to around $500 million. Unfortunately, we're only in heads of agreement, so no binding sale contract. So assuming that deal happens, I'll be able to advise people in the June quarterly report. This fund is actually 100% occupied, and it's invested across industrial and logistics, office, as well as long leased retail or long WALE retail. Our flagship industrial fund, Charter Hall Direct Industrial Fund number 4. So despite being called that, I can tell you we aren't doing another industrial fund. This is one of those roll-in funds. It's very large. It has over 50 assets, $2.5 billion. And as Andrew said, it's hard to get scale in industrial, and you've got to work very hard. So we've acquired a lot of the assets in this fund off-market through our relationships. And I'll shortly show you a video on one of the most recent ones. But you can see here, because the asset values and dollars are smaller, you do get a greater spread of the tenant customers. So no tenant comprises more than 8% of the net income of this fund. It is spread throughout Australia, has done exceptionally well in the last 12 months. And the other thing I'd say is we have been very disciplined. We've been running a lower gearing strategy in this fund, not because we necessarily wanted to be sitting as low as it was, but we wanted to be disciplined and making sure that the assets we bought weren't just for deployment, but which would deliver the best returns over the medium to long term. Anyone know what SPC stands for? Shepherd and Preserve Company. So this is an asset which we picked up in the middle of the COVID experience. We had very strong conviction on the industrial and logistics. We had very strong conviction on the food logistics. Governments, regardless of which country you're in, are not going to let entities or businesses like this go under. We're able to negotiate a 30-year sale and leaseback with CPI plus 0.75% annual rental increases. And when I play the video, you'll get an idea of the scope and the scale of this asset. And the reason why this asset's here is it's strategically located to the raw inputs that this facility and factory needs. So whether it's the existing company managing it or a future company, this infrastructure is critical food infrastructure for the Australian economy and people. The next fund is a little bit different, and I do want to stress this. It invests into listed property securities that are on the ASX. So everything I've just talked about is unlisted property. We tell people to invest for around 5-year or more investment term. So despite this fund also being in property, it is a liquid because all the assets it owned are traded on the ASX. For those investors that want high quality real estate but can't or don't want to be locked into a fund for a period of time, this is another way to access it. I do always encourage people, and anyone that's got a share portfolio would understand this right now, it's much more volatile. So you do need to be able to be comfortable because it does move around much more like a typical equity stock does. It recently won the Money Management of the Year award for 2022 and has a very experienced and high caliber team with 3 property professionals that have been running this fund for a long period of time. Now, the final funds I'll talk to before I wrap up my part of today's presentation is the Wholesale Property Series. So I said right back at the start of today's presentation, 70% of the money that Charter Hall manages is on behalf of North American sovereign wealth funds, European pension funds, and Australian super funds. So think of it as the big end of town. And we have a lot of high net wealth clients, family offices who said, Stephen, Charter Hall, how do we get exposure to those type of assets? So after quite a bit of negotiation with our group CEO and Managing Director, David Harrison, and our CIO, Sean McMahon, we were able to agree that this particular fund could invest alongside those investors. It is a little bit different in that you invest, they're only open for 2 years, and then as the underlying funds hit the review events, we redeem them and return the capital to investors. I should also stress it is only available to our sophisticated clients as defined by the Australian Securities and Investment Commission. So to give you a flavour for it, WPS1, we do like naming things relatively straightforward, so you wouldn't guess it's the first in the series. It's also diversified across a number of underlying sectors, being diversified long WALE, industrial and logistics, the office sector, as well as social infrastructure. So instead of a client needing $20 million to access one of our diversified pooled funds, or $100 to $200 million before we'll do an institutional partnership, we've been able to lower the entry point to $250,000. WPS1 is actually closing for investment in the next couple of weeks, but that's why I said it's so cleverly named. The WPS2 has now been launched as well. I should also highlight it does have slightly lower distribution returns. So we target around 4% and around a total return of 8 to 9%. So in our mind, it's the highest quality real estate available in this country. And what the whole aim was to make that big end of town real estate accessible to our high net wealth clients. You can see here the top 5 tenants, Telstra, David Jones, Bunnings, Coles and Government. If I ever get any questions, it's around the David Jones, which is their big flagship store. I can tell you we believe we bought that very close to land value. So the building, the land that's sitting on. So whilst we're very comfortable with the David Jones covenant and the 20-year lease that they've signed, they've also significantly spent a couple of $100 million in fitting that out. So if they were ever to close any more of the David Jones, it's highly likely they're going to pull them back into their flagships, being the one in Sydney, the one in Melbourne. And heaven forbid, if anything happened, I would back us to be able to generate a higher and better use of money in that location. It's heritage, it's fantastic, and you could go up quite significantly. So that's it on the funds, and I don't want to talk too much about the funds. I want to continue to give you a feel for the way we acquire assets and the type of assets we're buying. So I just played that short video on 333 George Street. You've heard earlier today around the Canberra office market having the lowest vacancy rate in the country. So we were able to pick up those thematics, and we picked up an asset at 40 Bundas Street down in Canberra. No surprise, Canberra is a government market, fully leased to the Australian government on a 7.6-year weighted average lease term. This is another recent acquisition by the PFA fund. LWF likes long-leased retail, and in this case, we're talking about a Coles-anchored shop. There is no other specialty retailers that hang off it. It is already in what's called turnover rent. Turnover rent is just a fancy way of saying that the tenant is trading so well at this site, typically your supermarkets, Coles, Woolworths, Audi, that they pay you a little bit of the percentage of their turnover. We like it because it provides that rental growth for our investors. And even now, as at 31 March, has a very long lease term of 13.7 years. 5 Dock is a great inner ring suburb, and if in the highly unlikely chance Coles ever wanted to vacate, Woolworths would love to get a centre in that location. LWF also picked up a recent acquisition in Newcastle. Newcastle is an area that the government continues to want to put population growth and employment into. This asset is located right on the major bus terminal, as well as the new transport infrastructure through the heavy-duty rail. Again, government lease, long-term weighted average lease term. And the reason why we want these new buildings to complement the existing portfolio is around that, what we said earlier, around that prime grade assets. So assets that do have those environmental credentials, that do have low ongoing capital expenditure, that have great natural light, that are close to amenity. These are the assets which we're targeting across the Charter Hall Group. But we shouldn't neglect the industrial fund. So he picked up an asset leased to Kmart, their major distribution centre up there in Brisbane. 5.3 years, and you heard from Andrew what's happening around the rental growth in that market. And finally, we picked up the asset lease to the Red Cross in Alexandria. It can trade and receive and send out deliveries of blood 24 hours. It's strategically important to them where it's located, being close to the airport. Whilst I can't at this forum tell you where they send all that blood, there are some sensitivities. Needless to say, they can't pick that up and move it from too far from there. So again, great asset, great tenant, and well located for their needs. I've got up here on the screen behind me a list of contacts for the team. A number of them are here today. I'll hang around as long as I can after this, answering any other questions. But please do feel free to reach out to any of the team should you have any other questions. And finally, I'd like to thank you all very much for joining us. It's been great to have so many people in the room. If you're an existing investor, and I know most of you in the room are across one or multiple of the funds, on behalf of Charter Hall and myself, I'd like to thank you very much for your long-term support. Without investors like yourselves, Charter Hall doesn't have a business, and we are very focused on earning the trust that you've put in us with managing your capital. So thank you very much, and I look forward to hosting this again. Cheers.